What is going on, guys? Nick here, back with another video. Nvidia stock has been on an incredible run this year, up 124% year to date, and for a good reason. The company's positioned itself as one of the biggest players around the future of computing, using all the advantages its GPUs have to offer. It's even in talks to acquire ARM, which potentially could give them an advantage over AMD and Intel in the x86 CPU market. So in this video, I'm going to take a look at what's going on with Nvidia and why the stock has shot up so much over the past year. I'm also going to show you guys why I decided now is the time to sell all of my Nvidia shares, even though I'm a big believer in the future of the company and buy and hold stocks. So Nvidia's big run seems like it started in May, when they announced their 4-to-1 stock split. When companies split their stock, it's usually a good sign for the management's belief in the company at the current price. Generally, companies that trade at small dollar amounts per share, like $1 to $3, are viewed as low quality, and companies that trade at high amounts, like over $1,000 a share, are seen as too expensive for regular people to buy shares of. So usually companies want their stock price to trade within a certain range, usually $20 to maybe a few $100s. Well, similar to what happened after Apple and Tesla announced their stock split, Nvidia started rising too. It went from a post-split price of about $150 per share all the way up to $200 by the time the stock split. On top of the stock split announcement, the company reported some great earnings. They saw the revenue up a whopping 53% compared with last year, and earnings were up 73%. Nvidia is known for its world-class GPUs. What makes a GPU different from a CPU is a CPU usually has 4 to 8 powerful cores it uses to calculate whatever the computer needs to do. But graphics displayed on computers don't require a lot of complicated calculations to adjust movement and shading. Just tons and tons of really simple calculations. And all of these calculations have to be done at the same time. In other words, CPUs can handle a few really complicated equations, and GPUs can handle large amounts of really simple equations at a time. Now, if you've ever watched AI or machine learning videos, it's basically just a bunch of guessing and then checking the answer millions of times. And this is what GPUs are perfect for. Nvidia's used its long success and experience in the GPU market to dominate the AI processor market. Analyst firm Omdia ranked Nvidia as #1 in AI processors with 80% market share. Nvidia's other important area of growth is in the data center business. The data center market is currently expected to create $120 billion in revenue by 2028. And the biggest data center companies, Amazon, Google, Microsoft, and Alibaba, all use Nvidia, as well as major IT firms, scientific research teams doing things like climate modeling, cancer research, and drug discovery, all use data centers. But Nvidia is not satisfied with just stopping here. They plan to buy ARM, which could give them an advantage over AMD and Intel in the CPU market. ARM chips are simplified CPUs typically used in mobile phones and tablets. Because of the simplified design, they don't use as much power or produce as much heat. But the drawback to their design is limitations with their total computing power. However, ARM chips have really improved recently, to the point where Apple ditched Intel to build their own CPU called the M1 chip, which runs on ARM architecture. And most of the reviewers have been blown away by the results of the M1 chip. Now, I have to say, I would love to have had an ARM chip in this MacBook instead of an Intel i9 x86 CPU, because regularly when I edit, I have to lift it off my legs to keep the skin from melting off. Nvidia wants to use ARM chips in data centers and in AI to complement their GPUs in the same market. Reducing the heat generation and power consumption of these massive data centers and server farms could have huge cost savings for the companies that run them. But Nvidia's $40 billion purchase of ARM is pending, and it won't go through until antitrust review from the US, UK, China, and the EU before getting approval. The news has been very back and forth on which way regulators will go on this, but most of the holdup is coming from the UK and the EU over concerns that the deal would weaken competition. If you ask me, I currently expect that the deal will go through, but it's hard to say this for sure. A few weeks ago, Meta Platforms,
Facebook,
announced a new push for
a metaverse.
Basically, they would work to create virtual reality simulations for all kinds of things, such as virtual meetings, which who in their right mind would want to do that? Most people don't even want to turn their camera on. As well as military training and immersive experiences, which I actually think could be one of the coolest ideas with this. Imagine watching movies, sports, or even recreated historical events in VR. Now the bells should already be going off. Virtual reality relies on a lot of graphics rendering. Nvidia is probably the best GPU company on the planet, which makes a lot of sense that Nvidia would do extremely well developing these products. Jensen Huang already announced the Omniverse platform, that could provide the structure metaverses could be built on. Apparently, Lockheed Martin is already testing the Omniverse to simulate and manage wildfires. Okay, so let's take a look at how Nvidia is performing. Starting with the revenue and net income, we can see the company had pretty flat growth between 2011 and 2015, around $5 billion in revenue. In 2016 though, the company really started to see growth from their data center business and the revenue started to take off. Between 2018 and 2019, we did see a fall off, and a lot of the blame comes from Bitcoin and Ethereum prices falling, reducing demand in Nvidia's GPUs, which are often used for crypto mining. 2020 forward saw a return to a huge amount of growth. When we look at the revenue compared with their expenses, I was actually a little surprised that a company with profit margins this high loses nearly half of the revenue to the cost of revenue. So this is a pretty strong sign for Nvidia. Now moving over to their segments, they only report 2 of them, but the information is more limited than I would like. They actually switched their segment reporting in 2020, so I don't have any information for 2019, and they don't include their segment expenses in their quarterly reports, so I don't have profits over the last year. But either way, we can see that the compute and networking segment shows a huge jump between 2020 and 2021, but this is a little misleading. Nvidia reported that the 104% revenue increase is from their Mellanox acquisition, and we can see that the growth from 2021 to the 2022 trailing 12 months is more slight. The trailing 12 months only shares 1 quarter from the 2021 year, so this growth is probably more of what we should expect going forward. Okay, so now that we have a good idea of what's going on with the business, let's take a look at why I decided to sell. So the current forecasts for Nvidia show the growth we've seen since 2016 continuing for the foreseeable future, with margins continuing to expand all the way up to a pretty insane 39%. Most likely this is expected because the high margins in their data center business. Looking at the revenue growth, Nvidia has been very up and down, hitting 50% growth between 2019 through the end of this year. But that growth is not expected to sustain and is expected to fall down to just 12 and 15% over the next 2 years. When we look at their net income growth, we see pretty much the same information, only the net income growth is expected to come in at slightly lower at 11 to 12% between the 2023 and 2024 fiscal years. So I think an appropriate growth rate for them to value Nvidia is between 10% for the bottom end and 15% for the top end estimate. A growth rate of 10% comes out to a fair PE of 22, and a growth rate of 15% comes out to a fair PE of 23. Now, interestingly, when we look at the historical PE ratio for Nvidia, we can see that historically they've traded a little above these numbers. In 2016, through the stock split announcement in May, Nvidia traded between a PE of 21 and 50. But since the announcement, the company has shot up really fast, and it's currently trading at a PE of 105. Now, a high PE based on trailing earnings isn't always bad. Sometimes it means the next year that the earnings per share is about to shoot up. So when I go over to my valuation chart, which is the forecasted earnings times both fair PE ratios compared with the stock price in orange, we can see that even all the way out to 2024, Nvidia's stock price is nearly double the 2024 valuation. This means that Nvidia would have to significantly outperform the current analyst forecast for the current price to make any sense. Nvidia has traded slightly above what I have thought the stock is worth, but I see that getting much wider over the past year. So after seeing this is what made me decide to sell the stock. Now, to be fair, it was only a small percentage of my portfolio at 4%, and I only had a little over 6 shares. I just think right now the price is so high, and if somebody's willing to pay me the current price for the stock, it's too good of a deal to pass up. It should be obvious that I'm not out on the business, and that I actually really like everything that they have planned for the future. I honestly expect to own shares again in the future, but I'm going to wait for the price to fall back down before getting back in. Now, if you could take just 1 second to scroll down and hit the like button before you watch this video right up here, I would really appreciate it. And as always, thanks for watching.